During these volatile times, our Malaysia futures market, especially the CPO futures, are experiencing the new price behavior movement. Especially if you're still new to trading or new to the CPO commodity futures market, you may have realized that the price movement for FCPO nowadays are unlike the historical movement, because on the higher end of the price, it's entirely a new territory that no one has ever experienced before. Hi, I'm CY. In this video, I'm going to share with you some of my perspective about how you can cope up with the highly volatile futures market and what you can do about it. Click on the subscribe button and turn on the notification bell so you won't miss any of the informative trading videos we are producing for you to help you improve your game as a trader. So let's get started. Now let's take a look at this intraday chart for a moment. This is a particular trading day during the mid of June 2021. And here we can see that on this particular intraday price movement, it has a high of 3,550 points and it goes as low as 3,298 points. So here we can see that there is actually a drop of 7.1% for this particular trading day, which is actually very huge. So this is what we call by the intraday changes. However, if we were to look at the overnight price changes, the overnight closing price, which is the yesterday's closing price, it is actually starting from 3,600 points and it goes all the way down as low as 3,298 points. On this particular day, we are actually experiencing a 10% drop in the FCPO market. So here we can see that volatility actually plays an important role in our trading, and if you don't understand volatility well, it can actually affect our trading decision as well as our trading psychology. Now, let's have a look at the intraday volatility and what is actually the historical intraday volatility. Intraday volatility is actually the difference between today's high price versus today's low price. So we take today's high price, subtract today's low price. So this is what we call the intraday volatility. So on this particular diagram, we can see that on the x-axis, which is what we label by year and then a month, and on the y-axis is actually on the volatility in terms of points. So on this chart, we can see that it is actually the past 10 years intraday volatility. And here we can see that throughout the past 9 years, from year 2011 until 2019, we can see that the intraday volatility, it is actually falls between the range of 25 points up to 60 points. So we can see that the average is around 40 points intraday volatility. So here, starting year end of 2019, we can see that the intraday volatility, there's a huge spike. It actually exceeds the historical 60 points of intraday volatility, and it goes all the way up to 140 points. So here we can see that as the FCPO price goes up higher, the intraday volatility would tend to increase as well. Now, let's look at the overnight volatility. Overnight volatility is actually the difference between yesterday's closing price versus today's closing price. So here we can see that again, throughout the past 9 years on the historical overnight volatility, the difference between yesterday's closing price and today's closing price, it is actually falling between the range of 18 points to 40 points. And starting at the end of the year 2019, there is an increase of overnight volatility as well, and it has been increased up to more than 120 points. So from these two diagrams, the intraday volatility as well as the overnight volatility, No wonder people are getting worried about trading the market that is highly volatile. So it is important for you to understand how you can deal with the highly volatile market. So here we can see that highly volatile market is defined as an increase in volatility as compared to the history, and this is what we call by the highly volatile market. And the question for you is that for the current highly volatile market, how are you going to cope up with this new market that is different from the past? In this video, I'm going to share with you 4 simple ways how you can cope up with this highly volatile market. You can choose whichever of these 4 ways that makes the most sense to you. Method number 1 is the safest and the most conservative way. And here I give it a 5-star of rating because of its safetiness, its steadiness, and it is the most conservative approach among all. So method number 1 is where during a highly volatile market, you can actually choose not to trade the market at all. And what this means is that you don't hold any position in the market. Or in other words, you can actually don't trade this market. So as long as you don't have any position in the market, whatever that you're actually facing or whatever volatility that is happening in the market has nothing got to do with you. So method number 1 is relatively safe and conservative because you don't have any position in the market that is actually causing you to stress out or panic. And of course, if you don't have any position in the market, you may not have the opportunity to make money from the market as well. So that's where we can have some other methods. So method number 2 is actually you can increase your speed in trading. Now, what do I mean by increasing speed? So because of the highly volatile market, you can actually increase your observation frequency in the market. Another way of how you can increase your speed is that you can revise your trading strategy to adapt to the new market environment. And what this means is that you can actually revise your technical indicator to have a shorter term parameter. So of course, this is a little bit not easy for a lot of people because when it comes to revising your trading strategies, there is a lot of work to do. So here I would give it a 2-star. And why 2-star? Because it takes a lot of effort for most people to revise their trading strategy and backtest all over again. And because the market speed is actually moving fast, you need to match the market as close as possible so that you can cope up with it. For example, it's just like when you are running on the treadmill. When your treadmill speed is moving fast, you need to run fast as well just to cope up with the pace. So for method number 2, not everyone is able to do it because due to our personality, our trading preferences, as well as our trading style. Method number 3 would actually make sense to most traders, and it is the most practical steps, which is to reduce your number of contracts. So for example, now that the market volatility has increased, you can actually reduce the number of contracts that you trade. For example, you can reduce your contracts from 5 contracts down to 3 contracts. And this can actually give you a little bit more additional margin for you to withstand the market volatility so you don't get margin call easily. And by reducing the number of contracts, you can also reduce your risk exposure on dealing with the market volatility. So if you were to trade 5 contracts, the volatility that you're going to feel from the market is actually 5 times. And if you were to reduce your contract size to only 3 contracts, you're actually going to feel the volatility by 3 times only. So here we can see that reducing the number of contracts can also reduce your stress level in trading the highly volatile market as well. So here for method number 3, we give it a 3-star out of 5-star. And lastly, method number 4. Method number 4, we give it a 4-star out of 5-star, which is where you can actually increase your capital. So if you do not want to reduce the number of contracts, you can actually increase the capital or the amount of investment that you put into your trading account. So method number 4 would be similar as method number 3 as well, where the purpose of increasing capital is to give your trading portfolio the room to fluctuate so that you don't get hit by the market easily, and then you may be facing margin call. So increasing trading capital would be a logical step for you to do to cope up with the highly volatile market. So that's it. I've shared with you the 4 steps of how you can cope up with the highly volatile market. So there are 4 steps. The first approach is where you can stop trading, and the second method is where you can increase your observation period or your speed of your trading by trading a short-term approach in the market. And method number 3 is by reducing the number of contracts so that it gives you room, and it also gives you more comfort in trading the volatile market. And lastly, method number 4 is where if you do not want to reduce the number of contracts, you can actually do it another way by increasing your trading capital to withstand the volatile market. Hopefully it clears up some of your doubts you may have in mind and have a better clarity on how you can deal with the new highly volatile situation. If you find this video informative and useful to you, please share this video and give us a thumbs up. And don't forget to click on the subscribe button and turn on the notification bell. Until next time, this is CY Song, wishing you good luck and good trading.